All right, well, good morning, everyone. Thomas Montgomery here. It's a beautiful Thursday morning. Today is March 5th, 2026. We get together most weekday mornings at this time, talk about the grant, talk about special purpose entities, SPEs. But our primary goal in these morning sessions are to answer your questions. What do you need to know? Whether you're a potential participant, someone looking to raise capital to start or grow a business, and or someone that's looking to collaborate with us as a distribution partner. So with that being said, in the background is our website. This website is incredibly important because it's our primary way of educating about the model. What we do, it's legal, it's ethical, but frankly, it's sophisticated. And it's very rare that someone will just hear the introduction and say, "Oh, I get it." Instead, typically what will happen is they'll either be confused or some people will say, "Well, this sounds too good to be true." In either case, the key is education, not persuasion, not manipulation. So on SBEfunding.com, there's certainly an introduction here, but more importantly, it's set up whereby we have a three-step process. And notice, actual participation is the third step, not the first step, not the second step. So we plead with people, whether they're looking at participating to raise capital or collaborating to help people and get paid, start with the trainings. We never, ever, ever want to have a client or a distribution partner come back and say, "Well, no one told me that," or act surprised. We have a very transparent model. And so we ask participants and distribution partners to diligently complete steps one and two. At that point, if they want to participate in a capital raise, it's easy to do so. Click right here, it'll pop up. It'll give us an overview page and then a one-page application. On the one-page application, the top half is business information. If we have it provided, if not, it states it's optional. Bottom half is key person. Now, when we talk about the SPE program, it is a legal and ethical approach to helping clients raise capital. It's a different approach. What we're doing is we're setting up a separate entity specifically for the capital raise. We guarantee that it'll work. It's guaranteed for 250,000 because of its construct. So if someone needs more than 250,000, either it's not the right vehicle or we can repeat it. We can repeat it concurrently, in other words, enroll multiple times at once or sequentially do one after another. But if you go through and understand it, it will make a lot of sense once you watch that training. Today, what we're going to do is have a bit more interaction. So we're going to do a funding review. I'm going to ask a couple key foundational questions, and I would like each of you, we have 630 of you on this morning. I ask if you would take a moment and respond so we can make this interactive this morning. Okay, so the first question is, why don't most small businesses who need/want funding not get it? So if you can take a moment to type into the Q&A, it's like a chat function of Zoom. What is your answer? In one sentence, one succinct sentence, don't worry about grammar or spelling or punctuation, but why is it, in your opinion, that most small businesses that want funding don't get funding? Because there's lots of small businesses, more starting every day across the country. There's lots and lots of lenders. There's banks, there's credit unions, there's alternative lenders. So the players are out there. There's no shortage of money. It's not that there's a shortage of money, and those lenders do want to loan money. What is it that is keeping small business owners from getting funded? And Mr. Brown maybe gave us the best answer. They are not fundable. And that's from Mr. Brown. And that's right, because what have we said in our prior trainings? If you want business funding, you need to have a fundable business. Now, to me, that's not a controversial statement. It's kind of a statement of the obvious. But I will tell you, a lot of people don't think that way. They want to dismiss that. Some people want a scam. Some people want something that's too good to be true. No, 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 don't worry about that. Just get me money. Well, you have to qualify. So there's many different types of funding, right? You can get student loans. You can get a mortgage to buy a house for you and your family. What we're talking about is, of course, business loans. But all loans have an underwriting element to it. Otherwise, they would probably lose so much they'd go out of business and they couldn't make loans anymore. So we, just as Mr. Brown said, we have to have a fundable business. And that's the most basic principle that we have to convey because, again, people often wish that to not be true. Now, the obvious follow-up question then is, what does it mean to be fundable? Okay, so Mr. Brown nailed it. We need to have a fundable business to get funding. That's why they often don't get funding because they're not fundable. So now we're going to go ahead and dig a little deeper. What does it take to have a fundable business? If you can go ahead and type in a response. A number of you got this. And so there's a formula for funding that a number of you just stated. And it is summarized as E plus the three C's. So we have to have an entity. The E stands for a business entity. If we want business funding, we need a business entity. Now, there's always going to be exceptions. I used to work for the SBA, which many of you know. Technically, there are some business loans that you can get as a sole proprietor, but that's not best practice. So we'll stick with the formula. In general, we need to have a business entity. That's not a real complicated feat. We provide one with the SPE. A lot of people already have an entity, but we do need that. So we can't overlook that. But more importantly, or more interestingly, I guess, are the three C's. There are different types of business financing and funding, and each have their own underwriting criteria. So, what we're going to talk about is the norm. The norm is helping clients get a large business loan that has low interest, small payments. Normally, it's spread over a 10-year, 120-month repayment term. That's the normal structure of a normal larger business loan. And when I say larger, 100,000 plus. So the three C's matter. And again, either a lot of people don't know that, or they don't really consider that, or they want to pretend it's not true, but it is factual. And so sometimes people get mad at us because of these facts that we're talking about. They don't want this to be the truth. They don't want this to be the circumstances to get funding, but it is what it is. So we have credit, we have collateral, and we have capacity. So there are some special options, unique circumstances where if we had just one of the three C's, we could get some type of financing. But in general, we're talking about normal business loans, low interest, low payments, three C's apply. So when we talk about credit, we know that there's two elements to credit, right? There's business credit and then there's personal. So they operate similarly in some ways. Both are a reflection of the payment history of either the business or the person, the business owner. Business credit can be built very quickly, and that's part of what we do through the SPE program. So we provide the entity, the E, and then we help them add trade lines. And these are real trade lines, real usable trade lines. If you hear someone say, oh, they want to sell me a trade line, or I can go buy a trade line. That's not normal. And it may or may not be legitimate, but typically it's not. That's one of those things that's typically too good to be true. And in fact, even could be considered fraudulent if you misrepresented your credibility by buying quote unquote a trade line and using that to get a loan. So we don't want to do that. We want to add normal primary trade lines. So we talk about that. So we have a training here where we talk about getting company cars. We have to get a company car. No, it's a best practice, but because a company car is an example of a really large trade line that builds the credibility of the business quickly, but that's an example. Business credit cards, business lines of credit are all examples of trade lines. And there's other trade lines as well. So we've got that training there, and then we have a training with our company car, the Porsche in the background. So business credit's important. We realize that and we address that through the SPE. Personal credit is an issue that more people are familiar with, right? We all should know we have a three-digit score. Pretty much anyone that doesn't have a good score has an excuse or a reason. We're not here to judge anyone. But what we've decided to do in the SPE model is not get caught up in this gray aspect of how do we take someone whose credit isn't very good because they've not paid their bills on time for whatever reason, and how do we go about making it look good so the lender will approve them. We've decided to step back away from that because, again, that could be gray if you misrepresenting credit to get a loan. So what we do is we provide through the SPE program, we just provide a cosigner. So if someone's personal credit is not strong enough to qualify, no worries, no problem. We'll just provide a credible cosigner. So E plus three C's is incredibly important. With the SPE, we provide the entity, we provide trade lines to put under that entity so the business is strong. And if the personal credit's not strong, we're not going to try to manipulate or masquerade it. We'll just provide a cosigner if needed. The second of the three C's is collateral. This is less frequently understood by many people. So typically for normal business loans, except for very small ones, if you get down below 25,000, sometimes less than 50,000, those smaller ones may not require collateral, but in general, normally larger ones do require collateral. And so now we're going through this ringing. So let's phone call to stop. Okay, sorry about that. That's actually our text line, which people shouldn't be calling anyway, but some people do. All right, so collateral are the assets that we're able to pledge to the lender that in case we don't pay it back, that they have something to cover their losses. So if you go buy a car, business or personal, the car is collateral. If you go buy a home or real estate, normally the real estate's collateral. But when you get to working capital loans, that doesn't come automatically with what we call the use of funds. So collateral is important. A lot of these folks aren't like you and I. A lot of them don't have collateral. So we provide the collateral in the form of $250,000 of collateral. So everything about the SPE is set up to qualify legally and ethically for a $250,000 loan. So we build the credit worthiness of the business, we'll provide a cosigner if needed, and we provide the collateral. And there's nothing illegal about that. We just do a lawful transfer. The third C is maybe the most difficult to understand and the most frequently understood. So we know that we need to qualify if we want business funding. We understand there's the three C's. I think most of us grasp the credit and the collateral. The capacity is where we're demonstrating to the lender that we can afford to pay back the loan. Now, dependent upon how the loan is structured, and let's actually go add that for a moment, because with being fundable, there is the formula for funding, but there's also the loan package. And so the loan package is the paperwork that brings it all together, that it's going to normally include the business plan, the financial projections, the feasibility data, which is independent third-party data to substantiate the assumptions and so forth. So with capacity, lenders want to be assured that the borrower can pay it back. Depending upon the structure of the loan package will determine how that has to be addressed. So let's look at two examples. Let's say that you and I are going to go buy a restaurant or open a restaurant, either way. Well, let's say we're going to open a restaurant. We're not buying an existing, we're going to start a restaurant. Well, will we be able to demonstrate that we can afford to pay back the loan for the restaurant when the restaurant isn't open yet? No, no, we'd have to have funding to be able to get everything needed to open the restaurant to start serving food. So, with that being said, certain industries make sense that the capacity wouldn't come about until after the loan is granted. That makes sense. But some industries, not so much. Some industries, especially service-based industries like management consulting, which we build the SPE around. Management consulting doesn't require a building, doesn't require inventory, doesn't require a bunch of staff. And so when you get into management consulting or many industries, the lender is going to say, is there enough money coming in now that if this growth that you expect from the loan doesn't occur, that there's enough to at least pay the loan back? So they can look at the business. Is it already cash flowing? Does the borrower have other businesses that are cash flowing enough to cover the loan? Does the business owner, the borrower, have personal income? So they look what's called globally at different sources of income. But absolutely the best way to prove up capacity is, in fact, to show that the business that's doing the borrowing, this entity, already has cash flow. And we provide that. That is, I think, the most unique aspect of what we do. Can people get help building business credit elsewhere? Absolutely. Can people get co-signers if their credit's not so good? Sure, they could ask friends or family members. We don't have a lock on that. Collateral's important, and then of course anyone could get collateral, but you have to be able to afford it. So that's a little bit more valuable in our proposition. But the capacity is absolutely huge. So we provide through the SPE model literally $250,000 of income in the first month. Now, this is an aspect where people often will look at, so oh, I give up. This is too good to be true. Why in the world would you give me 250,000? Or where does it go? It's not really going to me. I can't really use it. You have to understand. So with the SPE model, we're setting up a management consulting business as an SPE. What did we say? An SPE is for the capital raise. This doesn't mean that everyone wants to be a management consultant. They may have many other interests, but the SPE borrows the money under this model and then can transfer the money to other businesses or other purposes. But from a management consulting perspective, we can, and we do, develop the clients, transfer the client contracts to the SPE, and that's actually covered here where we talk about 250,000 in first month income. We provide an initial portfolio of 25 contracted clients who each owe 10,000 to the SPE. So when you break it down, it makes perfect sense. Capacity is an important C. Well, all three C's are important. Many small businesses don't get approved for a loan because they can't show the lender that they can afford to pay it back. We resolve that by setting up the entity, addressing the credit, addressing the collateral, but also by transferring client agreements to the SPE, and then those clients pay the SPE instead of us. Therefore, the SPE's bank account shows those deposits. It's really not that miraculous, but that's the model that we have evolved to because what do we need? We need the E plus three C's. So when you understand that, I think it makes a lot of sense. So the formula for funding E plus three C's along with the paperwork. So let's address some of the questions that you have. This is a very Cliff Notes version of the conversation. Again, the more details comes through the other training, but hopefully that helps you understand how we go about pulling this off. All right, so I see Richard has a question of the cost. Yeah, so we're very transparent. So the special purpose entity is not free. Some people say, oh, it's free. No, it's not free. We couldn't afford to do it if it's free. Look at what we're doing. We're providing the entity, we're providing the credit worthiness, we're providing the collateral, and we're providing the capacity. So to think that somehow we could do that for free is unrealistic. So there is a cost, but instead of people paying it up front out of pocket, it's paid through financing. So that's good news. And we're very transparent about the cost. So again, going back over here, go to step 3, it opens this up and it literally breaks down the cost. There's two elements of cost. There's a deposit and then there's a license fee. Now, when people see this, they all say, well, I don't want any of that. I just want funding. But we've got to go back. Well, what did we cover? Sure, you just want funding. But do you have a fundable business? And if you don't have a fundable business, that has to be resolved. This is one way to resolve it. I'm not saying it's the only way to resolve it, but I do think it's probably the quickest, the easiest. There's no out-of-pocket cost. And we guarantee in writing, we guarantee it'll work. We guarantee 250,000 within 30 days. So this is a real option, but it's certainly not the client's only option. So with that, there's a deposit, and the deposit is paid to start the client relationship. The client does not have to pay it out of pocket. There's financing available for everyone, and that's where we're going to put together the feasibility study, the feasibility data, and set up the LOI, which the lender will want to see. So again, that's consistent with these elements. So essentially, we're doing a lot of the paperwork with the deposit. Normally takes us 7 days, about a week to put that together. So then we can move forward to the license. And people are like, I don't want a license, I just want a loan. Well, fine, but you have to have a fundable business. We've established that. The license provides the three C's. So you can either provide the three C's on your own, or maybe you already have them. But if you don't already have them and you don't have a better way to get them, here is a way to get the three C's legally and ethically, and you don't have to pay up front. It's paid out of financing. So that's where the three C's come in. So that's what allows us to be able to add the trade lines, to provide a co-signer, we provide the collateral, and then we provide the capacity. That comes under that license fee. So when you look at it that way, it makes a lot of sense. Now, we had someone that actually asked a question. Well, this sounds, that they said, which isn't true, this sounds like an advance fee loan scheme, which is frowned upon by regulators. So if you're a pessimist, you'd say, well, wait, I have to pay 25,000 to get a loan? The answer is absolutely not. If you qualify for a loan, go to the bank. You don't need help. But a lot of people don't have a fundable business, as Mr. Brown stated. We've covered what it takes, and we've also addressed that we provide that. So we don't charge for a loan. We don't even charge a performance fee, or what some people call a success fee. You're not paying us anything for the loan. No. The loan comes from the bank or from the lender. You pay them back, of course, principal plus interest. But no, you're not paying for the loan. You're paying for the resources to legally and ethically qualify. All right, so Reggie is fine, but Reggie's saying this sounds too good to be true. But again, Reggie, you won't come to that conclusion if you'll do what I've stated. What I've stated is you've got to understand a lot of things in life sound too good to be true until you understand how it works. So until someone diligently goes through these two steps, and there's three trainings, right? Training 1, training 2 and 3, training 4, training 5 and 6. So it's a big commitment of time, but it's a sophisticated model. I don't know if Reggie went to law school or has his MBA or what his background is, but you can't just infer sophisticated concepts. But if you watch it, you'll see, there's nothing about it that's too good to be true. And I've attempted to summarize it because what's the bottom line? If you want business funding, you need a fundable business. And we've defined what it means. So, Reggie, to you and anyone else, however you want to go get your entity is fine. However you go accomplish legally getting your 3 C's is fine. However you want to go about getting your loan package put together with your feasibility data is fine. But this is what you need, and this is what we provide. So conversely, if this is what lenders are looking for and we provide it, then it makes sense that we can make the guarantee, which we do. It's in writing. We make the promise and it's summarized here. Expected financial rewards. Access to business funding financing of at least 250,000. So there's the promise, but it's actually in the agreement as well. 250,000 plus, not also, or not at the same time or same resource. Second bullet, we also provide 250,000 of first month income. And I've described why and how that works. Not too good to be true. And then if the individual wants, they can continue to operate the business, the management consulting, but they don't have to. And we've had other discussions about that. So I don't mind the skepticism that Reggie has. It's fine. But what we have to do is get knowledge to understand how it works. And this is an introductory conversation. I do believe that if you go through diligently the training that's here, you'll know a lot and you'll understand how it works. And then you can make an educated decision. Does this make sense for you or not? All right, so let's get back to questions because our primary goal today is we want everyone that has questions. We're at 635 of you now, 5 more folks came in. What questions do you have so you can make an educated decision? Again, assuming you've watched those trainings. So let me scroll through the many responses. Charles asked about the car allowance, right? So we announced the car allowance recently on training. It is described in this training here. And so I'll just summarize. But again, you'd want to go back and watch the training to see the full conversation. But one of the incentives that we put together is a reimbursement for a business car, a business automobile. We've showed you our business automobile. This is the training where we covered it. And so we'll reimburse up to 8,000 per month for a company automobile as an incentive to participate, but it's based upon your monthly payment. The monthly payment we have on the 911 is right at 8,000. So normally you can get up to about a $500,000 car for about 8,000 a month. That's why we set it that way. But I think what Charles may be asking is, let's say he buys an affordable car and the payment's 400 a month. Well, we're only going to reimburse 400 a month. It's to reimburse the company car that you select. Charles also asked about real estate and vehicles. Yeah, so that's a good point. So in addition to the 250,000 of what we'll call working capital, clients can certainly also use the SPE for automobiles, which we just covered, and real estate. So that would be on top of the 250,000 of working capital, and that is perfectly fine. So yes, that's on top of it. Let's see what other questions there are. Aziz is talking about getting funding approval. Yeah. So the key is we need to give the lender what they want to see to approve the loan. And while different lenders can have slightly different underwriting, and in general, it's this plus the loan package, and that's why we built it this way. We're the ones taking the risk. We're the ones literally giving everyone a written guarantee of the 250,000 in 30 days. So we couldn't make that guarantee and continue to operate if we didn't deliver off of it. But this is the why, this is the how. And if you can understand this, then it makes sense. If you can't understand it, it frankly, no offense, may just be too sophisticated of a model. All right. Let's see what other questions, concerns. Okay, another question is with the branch offices, so let's go back over there. So we are opening branch offices across the country. It's not a franchise model, it's called a license-based model, and you're welcome to do it or not. You don't have to. But there'll be one branch office per county, per state. The question is, let's say that you have Philadelphia, Pennsylvania. Can you help people outside of that county? Yes, you can help people anywhere, but we'll only have one office per county, one branch office. And the intent of that is so that way the referrals that come from the banks and other key influencers are not divided or fought over. So all the bankers in that given county, all the chambers of commerce, for example, would only refer to that one branch office. But yes, you're correct, Mr. David, that you could help people anywhere in the country, but it's the referral partners that we don't want to be having an infighting over. Enrico asked about the trade lines, which is a good question. So let's bring that back up. And he asked uh, about the approval process. Yes. So trade lines are extensions of credit that reflect either on the business credit profile and or on the personal credit profile. And that would mean that we apply, we get approved, and then it reports. We have business trade lines. Some do require a PG, a personal guarantee, some don't. So if personal credit's a problem, it will not be a barrier from us being successful because we can add trade lines that don't have a PG. And then from the personal credit worthiness, if that's needed for the large loan, the 250,000, then we can provide the cosigner. So don't worry about that. Let's see here. Mary asked, why is 250,000 being paid twice? Okay, well let's go to that because it's not being paid twice. First of all, the cost of the program is paid out of financing and it's 25,000. But when we think about the deliverables, right? So we need to provide the deliverables to get approved. The goal is to go get a $250,000 loan. So that's the first bullet. That's what we're chasing after. But what did we say? To get a loan, we need to have the three C's. One of the three C's is capacity. And the way that we address capacity, Mary, is we transfer 25 contracted clients that each owe 10,000. So we provide income, which is the second bullet, and also access to the loan. I see Mary's hung up on that, and a lot of people do, but if you just understand, it's two different elements. But we have to have the three C's, and that's how we provide the third C. All right, well, we've ran a bit long. We'll be back tomorrow morning. If you have other questions, of course, on our website is our phone number. You're always welcome to call with individual questions, but you really have the tools available to move forward if you care to. Obviously, start with educating yourself so you have an in-depth understanding. And then at that point, if you're looking for capital, here's where to go. If you're looking to get paid to help others, we have two models and they are summarized here at the bottom. All right. Well, thanks everyone. Great conversation. Appreciate your participation. We'll see you back tomorrow morning. Have a good day. Bye-bye.